Bitcoin maintained positions above $90,000 throughout most of 2025. Ethereum remained relatively stable all year. Market analysts proclaimed it as the moment crypto matured into a legitimate asset category. Meanwhile, your alternative coin holdings are obliterated by 95% and crypto social media has transformed into therapy sessions for devastated investors learning to navigate perpetual contracts. The optimists constantly claim this cycle is unique. For once they were correct, but for completely wrong reasons. Today we discover what transpired this cycle, the underlying causes, and the implications for crypto's trajectory. My name is Alex and you're watching Web3 Verse. Before starting, understand I'm not offering financial guidance, and nothing here represents investment recommendations. This is simply analysis from a recent industry report addressing some of the most critical questions surrounding today's crypto market. If you appreciate our content, demonstrate support by hitting that like button and let's dive in. When markets burn you, two paths emerge. Become cynical and disconnect, or intensify focus and discover how to position yourself strategically for the future. If you're pursuing the latter, you've selected the correct content. Today we're analyzing Wintermute's 2025 over-the-counter trading report, essentially a comprehensive market year review. Wintermute represents one of crypto's leading market-making operations, and regardless of opinions about market makers, few participants possess better positioning to comprehend exactly what's occurring in markets at any moment. Many anticipated 2025 would be the explosive culmination of the four-year cycle. All components appeared finally aligned. Wall Street and even governmental administration had pivoted strongly toward crypto. The regulatory challenges were resolved and previous obstacles were eliminated. If you held Bitcoin, you likely experienced a profitable year. As Wintermute's analysis indicates, there wasn't a failed bull market. BTC's value appreciated over eightfold between the $15,000 bottom in late 2022 and the all-time peak of $126,000 reached last summer. But as Bitcoin's price demonstrates, money flowing into crypto didn't evaporate. It simply became trapped in isolated channels beyond crypto social media's reach. Trading activity concentrated into BTC and ETH while only select altcoins captured the majority of trading volume. This reflected the gradual expansion of exchange-traded funds and digital asset treasuries to larger altcoins alongside the memecoin cycle's collapse in early 2025. Capital arrived, concentrated on major assets, and halted. This undermined altcoin holders anticipating a rotation of market participants extracting profits from BTC and reinvesting them further along the risk spectrum. Wintermute characterizes this as liquidity becoming more concentrated and unevenly distributed, driving greater divergences in returns and activity, which essentially means the rising tide supposed to elevate all vessels became confined to the harbor. Where capital previously flowed freely between assets, it now encounters structural obstacles that didn't exist in previous cycles. And this appears permanent. So if you want to survive in the new crypto environment, you may need to reconsider everything you understood about how it's supposed to function. In 2020, the strategy was relatively straightforward. Money entered through Tether, purchased Bitcoin on Binance, rotated profits into ETH when Bitcoin became stagnant, then spilled into altcoins when people desired more than 15% gains. ETH would surge, those profits would flow into DeFi, and eventually the entire phenomenon would reach NFTs and microcap tokens. Everyone utilized the same infrastructure, and liquidity was fungible. This new environment experienced an extreme stress test on October 10th, which marked the largest liquidation event in crypto's history by a substantial margin. The trigger was ostensibly Trump's announcement of new 100% tariffs on Chinese goods. But questions persist about why crypto declined so dramatically harder than any other asset category. Regardless, it was a catastrophic event for historical records with $19 billion in open interest liquidated within hours. The new dominance of ETFs and digital asset treasuries in crypto money flow helps explain why altcoins didn't receive investment last year, but they don't explain why retail stopped appearing initially. For that, you need to examine what else was occurring last year and where crypto ranked in the attention economy. Wintermute analyzed cross-asset data and the results paint a discouraging picture for crypto. UI era is apparently history. And if you want to succeed in 2026, you may need to abandon some old assumptions and truly examine the market as it exists now. Space stocks were up 64% for the year. Quantum computing gained 34%. AI stocks climbed 31%. Meanwhile, BTC was down 7%. ETH dropped 15.1% and altcoins fell 18%. If there was a narrative competition in 2025, crypto certainly didn't prevail. The same casual retail investors who were probably purchasing Bitcoin spot ETFs when they were the most attractive assets around in 2024 likely moved on. Projects continued attempting to generate the kind of narrative that previously drove altcoin rallies, but conviction failed to develop each time. This is what market exhaustion resembles. There was no shortage of narratives in crypto, but the demand needed to sustain any of them diminished severely in 2025. The capital that previously chased them was busy generating 60% returns in space stocks instead. Consequently, altcoins materially underperformed. Another major theme in Wintermute's analysis is the rise of over-the-counter crypto derivatives. As position sizes increase and market volatility continues, these are becoming the preferred venue for institutions to trade with size, discretion, and control and to tailor strategies for any market conditions. This was the case for Wintermute's own OTC desk in 2025, where options trading volume jumped 2.5 times year over year. But it's not just that more people were trading options. The way they were utilizing them has changed completely. In 2020, most options volume came from retail buying calls like lottery tickets on Bitcoin hitting $200,000. You pay the premium to purchase the option. If Bitcoin surges, you win substantially. If it doesn't, you lose what you paid for the ticket. That strategy creates explosive upside pressures because everyone's wagering in the same direction. If this sounds mundane, understand what this means for Bitcoin's price. Institutions selling call options against their Bitcoin holdings means when Bitcoin starts rallying hard, those short calls move into profitable territory. That means the institution is now obligated to deliver Bitcoin at below market prices. To hedge that risk, they have to sell their spot Bitcoin. The bigger the rally, the more they have to sell. This is a standard risk management technique called delta hedging. The effect is frustrating. Every time Bitcoin attempts to surge, there's a wall of institutional selling that reliably suppresses it. The old market had speculators buying lottery tickets, creating explosive demand every time the price dipped. The new market has institutions selling lottery tickets and hedging their exposure by selling into rallies. The house always wins, but only if the jackpot doesn't pay out frequently. Wintermute's report draws a direct conclusion about the crypto market. The traditional 4-year cycle is becoming obsolete. In their words, 2025 provided evidence that market performance is no longer dictated by a self-fulfilling 4-year narrative. The predictable post-halving euphoria, the alt-season rotation, the rising tide lifting all boats, these are outdated expectations that no longer fit the structure of the crypto market. What comes next depends on whether liquidity can actually spread beyond the handful of major assets that absorbed everything in 2025. Wintermute suggests 3 possibilities. First, if ETFs expand their mandates to include other assets, the floodgates open. There are already filings for numerous altcoin ETFs with regulators. If approved, mandate-bound capital gets new destinations beyond just BTC and ETH. Second, if Bitcoin explodes upwards, rallying so hard that the wealth effect overwhelms the structural hurdles to an alt season. If prices get really extreme, even mandate-bound capital could start to leak. But this requires BTC to go significantly higher than current levels. Third, attention returns to crypto. Tech stocks plateau, the AI bubble cools off, and retail capital rotates back to crypto with fresh enthusiasm. Wintermute marks this as the least likely scenario. For now, crypto's easy money era is apparently history. And if you want to succeed in 2026, you may need to abandon some old assumptions and truly examine the market as it exists now. That's all from me today. Thank you for watching Web3verse, and I'll see you in the next one.